everybody, and welcome to the latest issue of SFI Not So Live with me, Jay Evans, your host. I'm joined today by Tony Hall and Phil Lawford from Saffron for Intermediaries. Tony, I'll go to you first. A little introduction for anybody who's new to the podcast.
Yeah, hi, morning everybody. I'm Tony Hall, Head of Mortgage Sales here at Saffron. That's probably not what I need to say really at this point.
Pretty much it, to be honest. Everyone hears you every month.
Exactly.
And to Phil, say hello and introduce yourself.
Yeah, hi, I'm Phil Lawford, Business Development Manager for Saffron for Intermediaries, working closely with intermediaries all around the country.
There we go. And we're joined very, very happily by Liz Sims. Liz, do you want to do a quick introduction and who you are and where you're from?
Sure, yeah. I'm Liz Sims. I'm the CEO of Connect for Intermediaries. We have a network of advisors and we also look after advisors in the marketplace, distributing mortgage products as well. Plus we have a consumer channel also.
I'm not taking there, guys. A little bit of everything in there. Welcome, Liz. Welcome, Liz. Nice to have you. And finally, Ruby Hinchcliffe. Ruby, say hello and just tell us where you're from.
Hello. I'm not sure my introduction will be as impressive as that, but yeah, I'm Ruby. I am a reporter at FT Advisor. I joined back in June 2021, and I've been covering mortgages since I joined. So yeah, hopefully I'll know something to say.
Just for any new people to the podcast, we talk about things that are happening in the mortgage and property industry, give our opinions, have a little say, and offer you a little bit of advice as intermediaries and brokers on things that might be of interest to you. So do listen up. If you are listening on Apple Podcasts, Google Podcasts or Spotify, you can sign up for the whole series. So every time a new episode comes out, you will get a notification. So please do that. So without further ado, I think we'll jump straight in to our first story we're going to be looking at and discussing today. And it's actually from you, Ruby. It's in the FT Advisor with the headline of house sales are down by 22% as market finally starts to slow. So we're going to start talking about this. But Ruby, do you want to give us a little outline to the story and what you found?
Yeah, I mean, like obviously setting the scene, you know, we've just come out of a year where we've seen house prices grow. I think it's about £24,000 over the year is the sort of average value that's been added on to houses. So the market has grown significantly. And in terms of house sales, we did see a dip actually last year in October, quite a significant one. It was about 48.4%. But other than that, house sales have remained relatively steady. And then now, in January, according to sort of HMRC data, property transactions have dipped 22.22%. And I guess the consensus, I mean, last year, a lot of brokers were sort of kept saying, oh, it will slow, and it never really did other than October, but then it sort of bounced back again. But yeah, this year, I guess it's a sign of perhaps a more difficult market to grapple with. And, you know, I spoke to a few people. Karen Noy over at Quilter sort of was the one that I quoted in the article saying, you know, it's finally starting to slow. But there were other things that were mentioned in the piece. I thought it was quite interesting that one broker I spoke to spoke about down valuations and how, because the market is so expensive, I think it was Bob Riek. He's over in Lincolnshire, and he said that where he is, lenders are down valuing properties which have been outbid at the offer stage, which means that then clients are having to have liquid cash available to kind of foot that extra amount that these properties are being sort of overvalued by. And that's slowing the market down. It's making property transactions slow, and it's also making it less accessible for people to get into the market. So I think there's a whole storm of things, but I'm sure everyone else will be able to add something on that.
How's it looking for you? Have you seen this dip? I mean, we've had a conversation about it. I think even on the last podcast, we discussed a slight dip. How's it been with you as a lender?
Yeah, we're not seeing a dip in inquiry and activity. What we are seeing is, sorry, I'm getting heckled by a dog. I'll have to shut her out in a minute. What we are seeing is a lag between a decision in principle and application because of the property shortage. So we've got a big rump of people who want to buy a house that can't because they can't find one, or it's been downvalued, as you say, or they've been gazumped. There's still a hell of a lot of that seems to be going on. So I haven't seen as much of a noticeable slide from our side, and we are very purchase biased in terms of our product mix as well. I think it's not as mad as it was, and I agree that there are factors that are starting to hit it. But the biggest one for us is people who want to buy a house who can't find one, so they're very mortgage credit worthy, and we've got a list as long as this of decisions in principle where we've said yes, but they're not translating into applications because they can't find a property. That's our biggest problem.
Liz, you're nodding along there, so I guess that's it. That's it. Something you want to say?
Yeah, it has actually, because I've got the benefit of actually we've got a small estate agent and in the front of our office as well, and one of the things they're seeing is they've had having inquiries about going and having properties valued to put on the market, and then they're getting those initial inquiries cancelled because they're saying, well, I've actually had a look out and I can't see anything that's of any interest for me to buy. So there's no point in me putting my property on the market. And so you get this kind of really awkward spiral of nobody then puts their property on the market because there's nothing out there, because nobody's put their property on the market. So it's a difficult spiral. So I don't know what we can do as an industry to try and encourage people. If you are interested in moving, just put your toe in the water, get your property on there, see what sort of interest you get. I think the whole valuation bit can be quite problematic for mortgage advisors, because you arrange the mortgage based on what the expected value is, and lots of properties, they had multiple offers on them, back end of last year. They got a much higher price than perhaps the market was, and now when it comes to the property to be valued, it's not really worth that kind of premium that people were prepared to pay because of the shortage. So, are we back to renegotiating the price? Does your client have to pay more for a property, but they can't mortgage that bit? It can create a sort of a bit of a problem and a delay in the process. And I think the other thing that kind of gets factored in, of course, the big spike of property sales we had last year and the price increases and things for those, they're not really coming through on the pricing today, or only just coming through, because if you think about land registry, it's sort of 6 months behind in terms of the pricing. So when a surveyor is doing the survey, it's not necessarily looking at the most recent data. So it's very hard for us to get a real true reflection on where the market is at this moment in time. So it's lots of things coming at us to consider. Not in the least, rate increases are probably giving some people pause for thought as well.
Phil, coming to you, because you work with brokers day in, day out.
Yeah.
Brokers must be saying the same thing. They must be seeing this.
Yeah. No, I mean, I echo everything Tony said. Really, is that and Liz is that lack of stock is a key barrier to certainly to purchase business not completing. It's that supply and demand, and I think particularly in the first time buyer space as well, there's just not enough supply of those properties on the market, and that's sort of probably keeping that end of the market fairly high as well. And I can't see anything changing until we have a government that will tackle that and build. We need a house building program for first time buyers, and until there's more stock on the market for first time buyers, I can't see it going away quickly. We've got we've got some solutions like the joint borrower, sole proprietor, etc., which helps affordability, and I know we're going to talk about affordability further during this podcast, but the fundamental is we need more stock, and it's supply and demand.
Well, I'll tell you what we're going to do is jump to the next story on that, because actually that does really reflect quite heavily on the house prices themselves. So Rightmove, this was must plug, this was our mortgage introducer just a couple of days ago, The property prices, not HISEs, have hit an all-time 20-year record. So we're just shy of £350,000 in February for the average house price. I mean, that seems unbelievable at my age, looking back to when I was first looking to buy. And a £7,700 plus jump in a month between January and February. So we're really starting to see these prices rock, as we've just alluded to, and we'll come on to first-time buyers in a bit, as Phil just said. But what does this mean for everybody else? We're talking about this, and we just mentioned about the downgrading of prices, but actually the prices are ridiculous. It's getting to the stage now where are we just going to get into an affordability crisis, Tony?
Yeah, I mean it is, because it's the house price is great, and it's relative because what you're selling and what you're buying is matched, but it's the average price of a house far outweighs the income multiple and affordability required to actually get the mortgage in the first place. So, the quasi caps of 4.5 times income, it just doesn't get anybody a house anymore. So, it's that stretch there as well. So and that's why the average, first time buyer is now 35, because you can't afford it when you're in your 20s. So but I don't know how you stop it, quite frankly, but it is going to be that perennial problem. It does stagger me because, I start and watch a lot of, Place in the Sun and, A New Life in the Sun programs on Channel 4, which I love. And it's like, you can buy half of France for what you can buy my house for. And it's just so depressing. So, but I don't see any way to solve it, because the problem is, if lenders, and you're seeing lenders starting to do that, they're pushing up the risk curves in terms of the multiples they'll take. It's all still based on affordability. It's not just how much you borrow, we'll multiply it by 5 and you can have it. But those multiples are starting to stretch up. And it used to be you could have 5 or 6 times income if your salary or your joint salary was over 75 or over 100,000. I've now seen that drop into 50,000. So there's lenders now saying if your joint income's 50, we'll lend you 5 times income. But even then, that's probably, against the realm of everything. But so that's dropping. So lenders are doing their best to help, because we need to keep our share. But every time you're pushing that risk envelope that bit further, and it doesn't solve the biggest problem, is houses are just too expensive.
Yeah, it doesn't. The loan to income, even if you increase income multiples, it doesn't necessarily solve affordability either, because of I think affordability is going to be a big issue this year, because we've got 2 factors. We've got rising interest rates, which will mean that the stress tests as lenders we do are going to have to be higher, unless we get better guidance or freedom from our esteemed regulator, and the other factor is ONS data is only going to go up. The ONS figures are, which again, we base our affordability a lot of the time on ONS data. So with rising fuel bills, so those factors are going to affect affordability as well. So there's some challenges ahead, but we'll
tackle them as they come, as they say.
Yeah, tackle as they
Liz,
come.
You look like you had...
Yeah.
Yeah, I was just going to say, isn't it all relative? I mean, I know when I bought my first house in the sort of 1980-ish time, I was earning £15,000 a year, and my first house for £45,000. So what was a 3 times multiple at that point? But then the interest rate was sort of 8-9%.
Yeah.
So, we are in a completely different interest rate environment as well. So people get very hung up about, stretching these multiples. Exactly as you said, Phil, it's not really about multiples. It's about affordability, what interest rate environment we are in. And that is more of the concern as the interest rates go up. But even so, interest rates push up to 1%. Okay. I don't know if any of you guys remember at the time when, we had that overnight, it was 14%, and then it came back down again, didn't it? That was a really scary period of time. Yeah. So it is relative, and we've just got to do what we can do to try and be innovative about different ways to help people afford the mortgages as they are in the environment we're in today, really.
And is the answer. I know this. I am a bit of a self-build king. I absolutely love self-build. If I could afford to, I'd do it myself right now. But I'm not actually afford to my time. But is there an opportunity to for this self-build revolution to come through? We're behind on everybody else. Is that the way to afford it? Is there anything we can do there? Is there anything we can do to avoid these house prices? What are there any tips?
I was going to say, just chipping in, that there's a growing number of fintech lenders trying to fill this space at the moment, who are kind of claiming that they've identified this opportunity where it's almost like a loan on a loan, basically, where they're trying to push this equity loan solution so that people can afford the houses they actually want. And I think that could be something that sees an uptick in usage if people really just can't stretch to the prices that are now on the market. But there are obviously risks that can come with that, but it is an alternative. And I know that I've been speaking to a few of these lenders, and I've actually spoken to brokers as well, who have talked to me about these solutions. I mean, we might talk about it a bit later, because I know some of the other stories might touch on this. But and I've also spoken to brokers who've said that people have started to turn very fearful, and there is a real sort of caution by some buyers. I mean, I'm 25. I've got friends looking to buy houses, and they're just really quite downtrodden in the whole process. So I think that people are kind of searching for alternatives, and they're also a bit desperate. So that might mean that they will kind of take these solutions, which might or might not be the best suitable, just to get the house. So yeah, which is not great.
I'm a big fan. Sorry.
Go on, Phil. Carry on.
I'm a big fan of a house and opportunity. So some of these things, I think they are innovative and good. I think the key is that as long as they're sold right to consumers, so they're fully aware of what they're buying, and I think that's the absolute critical bit. But yeah, I'd agree with Ruby that they could play a part in helping find a solution, but it's all about they need to be sold right, and then obviously that's down to advice. Yeah.
Tapping into something you mentioned earlier about people being reluctant to move and staying in, and not wanting to sell the house because there's nothing to move on to. We've already discussed on this podcast, we discussed it all the way through the pandemic, that people have changed their perception of what their house is used for. So actually a reason to move might be that they need more space for a home office or whatever. But actually this sort of almost, damn it, I can't move, is going to actually see renovations going up. Surely people building offices and gardens, converting and changing, because the way we use our houses has completely changed now.
I think we've already seen that, haven't we? I mean, we're doing a garage ourselves, and the first thing thinking, well, how much bigger can we do the garage so we can have an office at the end of the garage, and everybody is doing the same, and I think that is great for the mortgage market as well, because we already know that there's a great big remortgage opportunity over 2022 and 2023. Over 300 billions worth of remortgages, coming in a couple of years. So mortgage advisors themselves, you might be a little bit concerned perhaps about the purchase market. It might be a little bit up and down, but the remortgage market, is going to keep us all very, very busy, as long as we're focusing on servicing our customers and addressing their needs and what they're looking for now, whether that is additional borrowing for renovations, tightening their belts up and getting better interest rates. What is it that they actually need? Maybe, and I know, again, we'll talk about it a bit later, borrowing more to improve the, EPC rating. That's a really big one for us over the next couple of years. So absolutely, I think if people are not putting their houses on the market, they are going to be thinking about, well, how do I make this a nice space for me to be in? Because I've seen over the last couple of years of the pandemic that I spend an awful lot more time at home, and actually I quite like it. So let's make the best of it, really.
I think we'll leave that there, actually, because I want to chuck into something we've already brought up very, very slightly, but we need to talk about in more detail. This story is from Mortgage Introducer, from Jessica Bird. The 95% LTVs, this is someone's opinion I'd like to add, will be the first to go as criteria tightens. So, it's not good news. This story is not good news for first-time buyers again. The threat that we might lose those 95%. Tony, I'm going to come to you first because we've talked about this a hell of a lot, and we've reintroduced Saffron's reintroduced 95%. At the moment, no sign of them going, but it's true, isn't it? When things get a little bit hard, a little bit difficult, those 95% are generally the first to go, especially from big players.
Yeah, I mean it's simple economics. There's more risk involved for a lender because the borrower hasn't got as much skin in the game. So, but it's also interesting because 95% will drop like a stone if you see prices dropping in the market because that negative equity and that concern. But it's going the other way. So that's one thing that's keeping that slightly up in my view. We are really keen to stay in the 95% market, and actually, throughout the pandemic, we didn't come out of it, albeit it wasn't a traditional 95% for the whole time, but it was more of what I think will continue to be a massive aid for first-time buyers, particularly following the last story about house prices, is our joint borrower sole proprietor product, of which there are others out there as well. So those which are allowing a family member to join them on the mortgage, I'm just smiling because Liz is laughing at me. That's my blatant plug. But I did put in others are available. Yeah. So that I think is certainly, if we had to pull out a 95, I couldn't see us pulling out of that bit because that we've been in it all throughout, so I don't see why. But quite a proportion of our lending at the moment is on 95%. It's one of our hero products. It's what the society is here to want to support. So, but it will get trickier to get a 95% because of the affordability challenges. As Phil said, we use ONS. And as that ONS data refreshes with the current costs of living, it's going to put a squeeze within that area as well. So it's easy to pull out. I think they might, but I think it's more the products will be there, just people can't afford them because of affordability, which is, I suppose, within a lender's gift to choose what they need to put into affordability. But there are some fair metrics from a regulatory perspective that you need to include. So it's not quite an equal playing field, but almost.
Ruby, I'm just going to jump to you here. Have you heard any rumblings of anyone starting to pull out? Has anybody been announcing news that these products are going, or are you not seeing that trend yet? Is this just an opinion of what's going to happen in 22?
I mean, not yet. And this is an opinion. I mean, this piece was written by a fintech lender, I think, when I had a look at it. So they've obviously got their own sort of narrative to push, and it would help them if lenders did pull out, because then their product would be more used. But I've not heard anything yet on that front. And I know we're going to later talk about kind of what happened when lenders did pull out the first time when the pandemic happened, and then the government stepped in, or to what extent they stepped in is up for debate amongst a lot in the industry. But so I think that if it did happen, it would be interesting to see what the reaction would be the second time, and going off how the government scheme did the first time. But I think if it did happen, then sort of the alternatives would have to be more than just a sort of taking another loan out to be able to afford the first loan. That it seems like a very unfair alternative for people to be stuck with, that they can't do anything else. So I think if lenders were to pull out, they'd have to think of other ways of helping first-time buyers. How they would do that, I'm not sure, but I guess I'm not a lender, so I wouldn't know. But I think, and even the fintech offerings aren't that perfect. I mean, I've spoken to brokers who have said the equity loan sort of solution, the monthly payments are quite large, and so buyers who are taking that option are still struggling to pay that on top, because so they were sort of saying, is there any way that they could reduce those payments? So even if lenders pulled out 95% and then people looked at the fintech lenders, they might still feel like that's not the best option because they wouldn't be able to afford the monthly payments. So yeah, it's a very, if they do pull out, it's going to be very bad news for first time buyers.
Liz, I'm going to jump to you because you were nodding away when Tony was talking. I was watching you. I'm going to come to Liz because I know she's got something to say on this. Are you still getting a lot of, as Tony said, a lot of applications in 95%?
Yeah, and I agree with Ruby. I haven't really seen much movement in the market of people sort of, coming out of the 95%. It would be a concern because a healthy market causes all different types of solutions. Because one solution doesn't fit everybody. So being able to have lenders that do pure 95% is great. That's one solution at that particular rate, and that is the simplest solution, of course. And so that's always going to be the first point of call. Does that work for somebody? If that doesn't, looking at things like joint borrower, sole proprietor, looking at things like equity loans on top, looking at some of the government incentives to help to buy and so on. Which solution fits that particular person and works out most appropriate for them from a sort of a mathematical and future-proofing point of view. That's what advice is, and so the more choice we have available with all of these different schemes coming out, the better. I must agree though, I do think sometimes some of these equity loans that sit on top and you're paying a 6-7% interest rate for that extra top up, you do sometimes think, well, actually, how is that going to be more affordable than maybe taking a 95% loan? It just depends on whether that enables you to get a 85-80% loan to value and the equivalent rate on the first part of the mortgage to pay for a top-up loan at a slightly higher rate, and then overall mathematically it still works. But that's the assessment that advisor needs to do, and as I say, the more choice the better, because then we can help more people.
Phil, there's been two mentions of joint borrower sole proprietor. Maybe we could, just for the wet behind the ears brokers that might be listening who perhaps don't know what the product is, do you want to just go, please don't plug the Saffron product, let's talk about it as a general product, but what is a joint borrower sole proprietor and how does that help the FTBs?
Yeah, I mean, the general principle is you have your buyer who will be the occupier who will live in the property, and the affordability is supported or boosted by normally a family member, and they are known as a supporter, but they won't be on the title deeds, but they'll be jointly named on the mortgage to help support the affordability. In essence, that's how it works, and it is a useful solution for first-time buyers, where very often they probably need, 5.5-6 times their income to achieve it, the loan or the property that they want to get them onto the ladder, and we've said earlier, 4.5 times income tends to be the maximum income multiple. So using typically a parent's or a close relative's income jointly on the mortgage will just boost them and get them to that extra bit of borrowing they need to get onto the housing ladder.
There we go. So for anybody who didn't know, that's roughly what that is. A little bit of a helping hand for first-time buyers. But, we're going to go on in a little while to affordability again when we talk about remortgages, which Liz nicely plugged a little while ago for us. But before we do that, we have just mentioned government schemes. Now, I don't want to get political, so let's not get too political. But they did bring out rather a lot of varied different benefits for us. I mean, stamp duty holiday, what a winner, kept the market buoyant. We can all bow down to them on that idea. It seemed to work. Probably the cause of most of our issues now, but it did work to keep the market moving. But the Mail Online actually called the mortgage guarantee scheme a damp squib, which I thought was quite an interesting term. I'm not going to say that's my opinion, but did it work? Did the mortgage guarantee scheme work? Was it well thought out? Was it planned? Did it have enough money? Did it have enough lenders? I'm going to come to you for personal opinion, but let's not go political. But did it work? Is it working? It's on its way out. Or is it gone already? It's not. Nobody seems to know what's going on. Liz, do people really know how to get involved? Do they know what it is? Or was it just something to say, we're trying to help?
I think it was a timely announcement of support in terms of this market when that was bought. But I think when you actually read the detail behind it and understood that, you know, the cost that the lender had to pay to get that security. You know, I know other lenders who just said, well, to be honest, we might as well self-insure and do our own 95% product. We don't really need the government's backing on this one, really. And I think it did its bit for the market at that time to get more lenders back involved with higher loan to value lending. So I think it was of benefit from that perspective. Whether many lenders use the product and whether many mortgage borrowers got that benefit, I wouldn't like to say what those statistics were.
Just on the government side, they say they helped 6,500 first-time buyers with the scheme in the first 6 months. But we'll take that and run with that. But Liz, I come from where you come from. I think it helped to push further lenders back into 95% market. So Tony, I'm coming to you, who's vigorously nodding while you're saying that. It did have that benefit, didn't it?
Yeah, I think Liz is right. It was a catalyst, and we certainly made the decision that, I think we were in it before it all started, but we made the decision that we'd always self-insured 95% anyway in terms of working with our MIG provider and all that. So we didn't need it, and I think that was the position that most lenders got to. But I think a lot, you know, it's difficult to say whether it was that much of a catalyst, because once one 95% lender comes in, another joins and another joins, you know, it's like buses. You wait and then we're all piling at once, and then you jump on the right bus. So if I'll be truly honest, it's not something that I can recall us as a lender talking about much, because it just wasn't relevant for us at that point, because we already had it, and I'm sure that was probably the case elsewhere. But look, it's helped 6,500 households get a mortgage, so let's not malign it too much. You know, it's helped, as you say, with all the government schemes, you know, from a personal opinion, lovely ideas in concept. Just when you try to apply them in real life, they're fraught with challenge. And that's the biggest problem. We need to clear up the clarity around how we do something, and not just have the wonderful ideas. Because there are some wonderful ideas, but if they're not executed correctly, they just become problems.
In defence of the government, we were in the middle of a pandemic, and they were trying to do what they could around everything else. So I think, you know, there's probably not as much time going into it as there should have been. Ruby, from your perspective, and you would have seen some government comms on it. You know, was it really pushed really hard, or was it just, you know, it was one of those things where we're trying to help, but you know what, we've got a pandemic going on in the background?
Yes, I mean, from what brokers said, they made a few points. They said it was too late, and that some said that most lenders, or a lot of lenders, had already back in the market by the time it actually launched. So there was a massive delay from when it was announced and when it was launched, or maybe not a delay. Maybe that was purposeful, but for brokers, they just saw that as a delay, and then meant that it wasn't as relevant. And I think also they sort of said as well that the main benefits were for the lenders of this scheme, and then the benefits weren't necessarily for the borrowers. I mean, arguably it was to an extent, but the reason was to get lenders back into the market and help them to provide these products. And then customers taking on these products are obviously a benefit as well, but it was first and foremost about getting the lenders back in. And I think some brokers also said it was running alongside the much better known Help to Buy equity loan scheme. Well, they said the much better known Help to Buy equity loan scheme. So a lot of people just didn't know about it, especially first time buyers. I don't think brokers felt that it was marketed in the way that it should have been to actually get some traction. And when I covered it myself, I sort of looked at the data, and I think between July and September, the £1.01 billion in mortgages done through the scheme was equivalent to about 1.3% of the 78.9 billion in mortgage commitments made in the third quarter of 2021. So it gives you a kind of idea of the scale of it. Obviously quite small, but as Tony said, probably shouldn't line it too much, because it did help people at the end of the day, and some help is better than none. And I spoke to the Treasury, who felt that they had helped to reinvigorate the market. And I think from the beginning of the year in January, I understand there was around sort of 95% loan to value mortgage products available from a couple of lenders. And then by the end, I think there were around 50 lenders offering around 350 of these products. So yeah, I mean, they were part of why that happened. But arguably, I mean, I think lenders like Accord were some of the first to get back into this market. And that was a bit before the scheme. So like Tony said, once a couple get in, it's going to naturally happen anyway.
There were some caveats to it too, in that you couldn't. It wasn't suitable for new build homes. So actually, it was designed for older stock, smaller priced homes. So actually, those that are maybe a little bit eco-friendly, it would be a house that perhaps wouldn't be on their eye line. So there were loads of caveats to it. What was quite interesting in this story was a comment from Richard Donnell from Zoopla, who said the appetite for 95% borrowing is lower amongst consumers than it has been in the past. Due to lending regulations and tighter rules, to get a mortgage means someone needs to be on a high income to take a large mortgage relative to the value of the property, which I guess is a fair comment. But Phil, I mean, we couldn't do without the 95%, but, we've already talked about other things. But, this scheme, as Ruby just said, alongside other schemes that were available, the Help to Buy, which, was successful, it was a nice attempt. But what can we do now? I mean, we're in the 95% market. Is there anything more we can do?
No, I think the problem is I can't see 95% going. I think it will stay unless there's massive disruption to property prices. But in terms of solutions, the biggest problem is going to be around affordability. So unless lenders can have more support from the regulators in terms of how we can stress test, then that's I think is going to be our biggest barrier. So I know we've mentioned it previously. Lenders are stress testing still probably at around about 8%, are using rates of 8%. Now, even with interest rates going up this year, even if they double, we're still not going to get anywhere near that anytime soon, as far as we're aware. So I think we need to be giving a bit of slack on stress testing personally, and that would then help borrowing a bit more in terms of stress testing, because again, you see a lot of clients who are paying rent, and they've got a good track record of paying rent, but they're failing lenders' affordability assessments.
That's quite interesting, actually, because it goes back slightly to what we were just saying in the previous story, in that, as Ruby was saying about the fintechs coming in and the loan to get the affordability and to get that through there. Actually, from a consumer perspective, and this is actually personal experience, my sister was thinking the same thing and thinking, okay, I'm not got affordability, but actually I can borrow a little bit towards it. But she's failing affordability, and I think it leads on beautifully to the next story, where we were talking about the remortgage boom, Liz. It's being threatened by the tightened affordability, is the next story, which came from Mortgage Solutions. They're saying that the number of affordable remortgage inquiries fell to 78%. So again, go back to what we were saying, compared to 85% in November last year. So affordability is going to be a big topic for us, especially as we lead towards April. What effect is this going to have on the market? Liz, should I come to you first? You're nodding.
Sorry, I thought you were coming to me anyway. But yes, I think there's a couple of things here. Firstly, that there is two elements to the issue, isn't there? There is how much deposit somebody has versus the affordability of the monthly mortgage payments. And some people have both issues and some people only have one issue. So it's those different innovative products that are out there in the marketplace that are addressing different parts of that particular problem. So things like so I'm just really kind of addressing Phil's points at the moment, but things like Bank of Mum and Dad, and some of the other innovative solutions that are coming out in the marketplace at the moment that allow perhaps friends to provide equity stakes and things like that into the property. Those are really, really interesting, and I think they're addressing that other part, the deposit side of the issue. Coming on to what you're talking about the article in terms of the remortgaging affordability, I suppose we'd have to look at the detail behind what's being searched for. So is it that remortgages are being searched for, but remortgages with quite a nice large chunk of capital raising to be able to do that garage in the garden, and to have the home office, etc. So that was about, I believe that article was about, a system that's being used to kind of produce quotations rather than the actual reality of applications that have gone through and been deemed affordable or not. So I think we just need to be clear on what we're saying here in terms of that article, because there are, even with remortgages, some of these solutions, those innovative products that are in the marketplace, can still be used. You can still have your bank of mum and dad helping you with a remortgage, and we're seeing a lot of reverse to the bank of mum and dad, actually, bank of son and daughter helping mum and dad as well. So I think that continued innovation is what's going to see us through some of this, definitely.
I think that led me beautifully, actually, because I was going to come to Tony on that very subject. Tony, this is about tech. This as Liz just said, the crux of this story comes from a broker tool. So actually, it's from a technological perspective, yes, it doesn't look good on paper, but actually we say this a lot, and I'm going to let you say it rather than me say it, but it's about an approach to lending, isn't it? It's about, having that advice, that guidance. Technology doesn't always give you every avenue you need. So actually what they're bringing up here from a computerized system, yes, fair enough, but actually practically not so true.
Yeah, as we always say, it's a bit, as a specialist lender, and as a lot of specialist lenders will, their clear statement is we're a common sense lender. We'll take every case on its merit and view it then. So if affordability does say no on the system, that isn't necessarily a no. So I think for the message for brokers is there's always a solution to someone's problem. It's just how much they're prepared to pay for it. Sometimes, if to get what you want costs you more. But I always say to everybody, and I think I've said it on this, this podcast of previous lives, where someone asked me, they didn't think they'd get a mortgage. And I said, anybody can get, most people, not anybody, obviously caveated, most people can get a mortgage somewhere, but it is, so don't ever think you're stuck, because there's always a solution across the broad spectrum of lending, so it is very much about, for us, it's about common sense. It's about we use this mortgage business broker tools is a great system. It looks across every lender's affordability model and just spits out a list saying your range is from here to here. So because I've seen it, and it's a really good system actually. So it's really helpful from that. But as you say, it doesn't pick up those nuances. And I think Liz is right. A lot of people are remoing and capital raising, and that's where the challenge comes, because wages are not growing as fast as inflation, and the cost of living and everything's going up. The other side of it, not so much from this, but the amount of adverse in the market now, the amount of people who are struggling with CCJs and defaults and arrears is growing exponentially. We're seeing that, probably. Would you say, Phil, probably 90% of our current declines are because of adverse?
Yeah, the adverse is definitely ticking up.
So that's really. Yeah. Well, most of the inquiries we get on the phone are, I've got this, but, so that's a real key. I think going back to the affordability piece, as Phil mentioned, it's around that stress testing. So it's great news to see that the FCA are starting to look at that stress rate on anything but a 5-year. Because that's the other issue. How many first-time buyers or customers are being squeezed into a 5-year mortgage because it's affordable, as opposed to what's actually right for them? Particularly first-time buyers as well, which is normally a 2-year, because after 2 years you can potentially remo away and take advantage of the property price growth, but not pay over the odds for it, or you want to move within 2 years. So there's some there's some poor outcomes for customers as a result of stress testing as well that need to be addressed, I think.
Outside of the stress testing and that side, and let's talk about the affordability and the cost of living crisis and where we're going to be. Tony just brought up adverse, which we know is more common now, and that's an impact of the pandemic. But Ruby, across the market, there's a lot of fear about this cost of living crisis. I mean, what's happening, we won't mention it, but what's happening at the moment in the news is massively affecting our oil and gas prices, which is going to hit us even harder. Is the industry genuinely concerned now? I mean, we are as individuals, we're worried about affording to live. But there must be a market shift, a market concern there about where this is going.
I mean, I think there is. I mean, this month, UK reached its highest level of inflation since March 1992. So it's quite a scary time. And I mean, I can speak on both levels, sort of speaking to brokers and speaking to friends of mine. Like when I speak to brokers, when the Bank of England decided to raise the rate recently, I know it's in it twice, but the most recent one, some brokers did come out and say, you're crazy, like that's really going to hit people hard in an environment where people cannot afford anything. I mean, obviously there is strategy behind raising the rate. But in the sort of short term, it's going to impact people quite severely who are already paying over the odds for everything else. And I think the Bank of England don't reckon that it's sort of going to kind of start really people feeling the effects until next year. So of the rate rise and it's linked to like wages as well and wages slowing, but they don't think that's going to come into effect really the wages side until next year. So yeah, I think a few brokers are kind of worried about how their clients will fare this year. And then even just talking to friends of mine, like 25-year-olds don't usually worry that much about inflation, but I know that a lot of my friends are actually worrying about it now. Like they actually are watching the news and thinking, oh God, this actually sounds quite bad. That's a high number, and so yeah, there is a lot of fear among young people and that sort of, I guess, first-time buyer generation. That
Ruby, you are younger than us, so I'm going to come to you on a personal question. Are you on the market already? Or are you worried about getting on the property market as you get older? Are you on there now, or are you not on?
I'm not quite yet. I've got friends of mine that have just got houses, so that's definitely making me think, okay, I'm at that age now where I need to start thinking about it. And I have been saving a lot, so I'm getting to a point where I think at some point I'll be able to afford, probably not in London because I'll be buying on my own. So I think I'd have to look outside London, but definitely in the next couple of years or next year even, I want to start kind of looking at what my options would be. But yeah, unfortunately, even if I'd want to settle in London, I just don't think it would be possible. I might explore some of the more rural areas, but yeah, actually being where I want to be in London, I wouldn't be able to be. So then it's like, what's the point?
I had to ask you because you mentioned your age a few times and you're a fair bit younger than the rest of us. And I have the luxury of not having a mortgage. I'm one of the only one on the panel. My house is paid off at 42, so I'm quite happy. But, I don't have any of these problems. But then actually the thought of moving frightens the life out of me because I got a cracking deal on this house. I'm going to have to get my first ever mortgage if I want to move. So I'm probably never going to move. I'm probably going to stay here. But, the market, it is a scary time for everyone. And Phil, Ruby just said she speaks to brokers all the time too. You speak to them all the time. Are your brokers concerned? I mean, this cost of living crisis doesn't just affect first-time buyers. It's everybody. All our bills are going to go up. All our fuel's going up. It's not changing.
Yeah, absolutely. And right, echo everything there. But brokers obviously are concerned, as we all are, because it's not something that's going to ready to go away quickly. Really interesting the point you said about London. We're seeing quite a lot of, we're starting to see, and brokers I'm talking to, seeing a lot of folk who live and work, rent and work in London or around London, but they want that they effectively should be first time buyers coming into their early 30s and want to get on the property ladder or have a foothold on the property ladder, so they're actually doing buy to lets. So they've got they've got a foothold on the property ladder, so they're buying a property outside London in a cheaper area, purely so they've got equity in a property, and they're renting that property out. So they've got foothold on the UK ladder, but they're still renting and working in London. But so we're seeing a bit more of that now as well.
You can tell that's jumped up. I live in Norfolk, but I work in Cambridge, and I considered a move to Cambridge. And actually, Cambridge house prices are nearly at London levels simply because of the easy train journey. And the problem is, you get on the commuter belt, and all of a sudden, those prices, almost in cities at least, are rocketing up as high as London. I mean, rural is the way forward. Not that I'm an advocate living in Norfolk, but yeah. So that leads on to saving money, which is what I'm going to move on to next. Well, let's talk first about saving the environment. We're jumping back to TFT Advisor, Ruby, and we're talking about the green mortgage market. I want to bring something up on this, something that I'm very passionate about, so we'll come to that in a minute. But what can advisors do to support the green mortgage market? I mean, I had a conversation yesterday with somebody and then went on to talk to a few brokers afterwards because I was really intrigued. And there are products, green products on the market that brokers don't really understand. And actually they have exactly the same rate as a normal product, but you save money if you upgrade your house. So in Saffron's case, sorry to plug, but it's called a retrofit mortgage. So you would get a reduced rate in the first 6 months if you improve your home. But the effect of that has a really good knock-on effect. Your house becomes more energy efficient, therefore you're saving on your bills. I mean, it's not going to knock off all the effect of the rises we're getting at the moment because they are dramatic, but it is a way of saving money and improving your home. And also, but let's talk about the green mortgage market as a whole. Liz, I'm coming to you first because you work across and you know a lot about the market that's going on at the moment. How big is the green mortgage market? I mean, I'm going to use a phrase that I'm going to talk about in a minute called greenwashing. We've all heard it, which is, I've got a green product, but actually does bugger all for the environment or anything to do with anything. It's just got a lovely green label and I'll put a green bit of font on there and look at me, I've got a green product. So in reality, how big and how real is the green mortgage market?
Well, I think the market is definitely very real. I think it's massively on the agenda of the government for all different reasons, and therefore, whether it's actually lip service at this moment in time or not, it's got to get bigger and better in terms of what we're doing about the environmental issues at the end of the day. Lenders, as Tony will know, have got targets of getting, all of their back book to a certain, EPC rating. Housing stock is 40% of the green gas emissions. So we've got to collectively, as an industry, do something about it. Whether the products we're bringing out now are really ticking all of those boxes, maybe not, but it's a starting point, isn't it? We've got to start somewhere. And everybody's got to get creative and got to get ideas on the table and start moving in the right direction at the end of the day. I think the challenge with some of the products that are the same rate but have the green underlying benefits for if you improve your EPC rating is if you think about the traditional mortgage advisor journey, as they're looking at products, they're looking at a rate system. And they're not necessarily seeing on a rate system that differential. Literally only in a very short time ago did a filter come onto our sourcing system to enable you to filter out green mortgages and look and then compare them. But that also then relies on advisors bringing that questioning into their fact find process. What do the consumers feel about that? Are they prepared to pay a little bit more for a green mortgage? Do they plan to improve their home? And will they get benefit from getting a green mortgage that gives them, rewards for that? And we've got to bring that right in at the front fact-finding process as well. And then into the research process and getting more education from brokers. And then obviously bringing that together with all of the innovation that the lenders are looking to try and put forward at this moment in time.
Ruby, I'm going to come to you because, again, sorry to pick on you for your age, but we're all a load of old fogies. But do you think that... sorry, guys. But do you think that as the millennials, the Gen Zs come through, there is a much stronger will for living a greener, eco-friendlier lifestyle generally. So do you think we're going to start to see, as these people come up, obviously we just talked about the fact that first-time buyers are slipping towards their 30s, but actually this generation coming through now, are they actually going to be more engaged with this? And do we need now to educate the brokers, as lenders educate the brokers, and as other platforms, to kind of encourage brokers to talk to these audiences as they would want to be spoken to and understand what their wills are? You know, you're in that generation. Do you think you're in the generation coming through that will care more?
Yeah, I mean, I care about the environment, and I think that it is an education piece, like you said, and understanding the impact of these changes over a longer period of time. So if I'm looking at a house, it needs to be a sort of conversation of, okay, so these things will make this difference over this period of time, and that's, and you know, the monetary benefits of that as well. That sort of thing needs to be communicated. But I spoke to brokers about this in October, many of which talked to first-time buyers, and they basically all said that the topic was virtually unspoken of. That was a quote, a direct quote, and unconsidered in the mortgage buying process. So it sort of touches on what Liz said about that conversation. The clients aren't pushing it at all. And that was 6 brokers who all basically said the same thing. They don't prioritise EPC ratings in discussions with clients, but some of them did acknowledge it could be a conversation in the future. So I think at the moment, brokers are sort of pushing it outwards and not sort of thinking about it right now. But there were also points they made around how most A and B rated homes, and this is a quote, tend to be new build, and there's a lot of evidence that actually the build quality on new homes is poor and that they aren't energy efficient at all. And I've got friends in construction, and I was actually talking to someone yesterday about this, just saying that, yeah, you've got to be so careful because the quality of some of these new builds is really bad. And if you don't know that, you can go in and then there's just leaks on every floor and there's nothing you can do because you've kind of trapped in that situation. And I think also another thing that broker said to me is that they don't think they're going to get into a situation where lenders are going to refuse lower EPC properties. They'll just favour the higher EPC rated ones. So there won't be an outright sort of no, it will be, yeah, prioritisation, but that still will affect people badly, just perhaps to a lesser extent than maybe the scaremongering is suggesting. But yeah, certainly, like, I mean, I think I'm more educated than the average sort of person my age because of the industry in which I work. But certainly, like, I hear a lot of awful stories about people getting in situations where they've gone for new builds and then found sort of massive problems with them. So that's then made me more wary of asking more questions. And yeah, it's not even just about EPC. It's thinking, okay, great, it's an EPC rating of this, but let me think about all the other things that might come with this property as well. So that it's not just railroading EPC at the expense of other really important things.
Sorry, don't figure it out. For me, in terms of coaching my advisors, there's 2 really, really important things that they've got to be thinking about at the moment. And we do an awful lot of buy-to-let within our network. And right here, right now, obviously, our clients, we're trying to educate our clients as well of the changes to the EPC, meaning that any brand new tenancies, their property can only have an A to C rating from 2025, and then any existing tenancies, they've got to be from 2028. So if you think about, as an advisor, you're recommending a 5-year fix today, for example, and you know, part the way through that 5-year fix, they lose their existing tenant. They're within this time frame that we're talking about, and then are they going to have a problem perhaps capital raising money because they're tied into an early repayment charge, but they need to capital raise that money to fix the EPC issue? So that's a really big issue. I mean, we put out some consumer marketing over the weekend, actually, and we had a portfolio client just call and say, is this just marketing or is it really true? Am I going to have to do this? You know, and so there is a lack of awareness in the marketplace at the moment, and that's a really fundamental thing that we need to be talking to our clients right here, right now. And I think that, and combined with the requirements for the back book of lenders to obviously get to an average of C rating, we have already seen one lender come out to us, one of the specialist lenders come out and say from May they will not be accepting any ratings below D, and if it is a D, there has to be a reasonable demonstration that it can achieve C. So that's a really big first lender coming out and saying that. So that's why I was picking up on your point on that kind of worry. There is already a lender out there that's come out there, and I'm really interested to hear from Tony. Perhaps, what is the thoughts from other lenders? Are they planning to kind of restrict this kind of, these properties that don't have the ability to get up the rating?
I think, I've just written it down actually because I'll be truthful, it's not something that's really, it's on our agenda, but it's not something that we have really discussed at length. And funny enough, I've got our committee meeting that discusses this next week, so I will raise that to flag that someone has done it. I think it's one of those, if once it's toppled, it will start and you'll see others, because I can't see how else a lender can directly influence its energy efficiency of its back book. You're talking thousands and thousands of mortgages that, in order to get these properties to a state, you've got to lend people more money. Some who may not want to do that or can't afford to do that. So God knows how it's going to work. So it's not something that we have discussed and have any plan for yet. We know it's coming. We're kind of, I suppose, waiting for a bit more, I suppose, guidance from trade bodies and UK finance and etc. But I will now raise that because I've written a note down you saying that a lender's come out and said it. So that's an interesting one. I mean, going back to the whole green stuff, I think there's I've just made some notes. One thing that lenders can do more and need to do more, but it's the industry needs to do more. I keep saying this, but modern methods of construction. We know that they're more efficient. We know that they save people money, but it's still a big no-no for a considerable amount of lending. Surveyors don't like it because there's not too much of a back history of it. We're reticent to say we'll lend on it. We've got to break that cycle. Ourselves and a lot of other lenders are far more appreciative of modern method of construction. And we'll take a view on it, but even then there are still restrictions against what we could be doing as lenders. And then the other thing is around affordability, going back to that quickly, is we don't make any accounting for the energy efficiency of a home when we're looking at costs. So when you're basing affordability on statistics of utilities or other things, we don't go, actually, if your energy is here, your affordability is lower. So it's not rewarding somebody for trying to buy a more energy efficient home or move, upgrade to a more energy efficient home. So I think there's a lot that we can do as an industry, and it will happen. It's just I don't think we've met that critical point yet where there's so much demand that you can't ignore it anymore. We're still in there. It's nice to have, and we've been out there with green for 2 years with our retrofit, but we've never really pushed it because no one's really listened. They are now listening, which is great, and we're seeing inquiries tick up, but it's still, we're not at that seesaw yet where public sentiment and demand is coming this way to make lenders do more. So I think we might achieve that this year. I think L&G said in a recent report that from their lender base, over 50% of their lenders now have a solid green agenda for 2022. Some with product already, some developing products. So I think you'll see a big switch this year.
End on this note, but we've had a bit of a lax after COP26 being the pandemic. It's been a very sort of lax move, but I think it did open the eyes. I think it got forgotten about quite quickly, all the things that were going on at COP. But actually, people are opening their eyes to it a little bit now, and I think that's generational. I think the older generations, right down to youngsters, are really starting to pay attention to what we're doing to the environment around us. We've run out of time. That's been we've flown through that hour so quickly. I just want to say a massive thank you to Ruby and Liz for joining us. It's been brilliant to have you on. Your insights have been really, really interesting as well. It's nice to get the outsider perspective. So thank you to both of you ladies. And do come and join us again. We're every month, so do join us again. And any special ones we have, we'll invite you along. So thank you both. Thanks to Phil and to Tony. And I believe Tony and I will see you next month, probably Phil as well. So see you next month for the April edition. And just a reminder that we have our next webinar, which is on the self-employed and contractor markets on Wednesday the 9th at 11 o'clock. You can nip onto our social channels and get yourself registered now. Don't forget to sign up for this podcast as a series so you get a notification when the next ones come out in April, where we'll be back and we'll be looking at all the big stories that happen over March. So thanks again to the two ladies. Thanks, Tony and Phil. You've got your name then, Phil. And we'll see you next month. Take care.
Bye.
Bye, everybody.
Bye.